Hi there, and thank you for joining us on this pre-recorded webinar. Now, I guarantee you this will be the best hour you've ever spent on your property investment education. Now, I'd love to offer you a money-back guarantee, but seeing as how it's a free webinar, I can't really do that anyway. But look, I stake my reputation on it. You will get so much out of this hour, you'll be very, very glad that you watched it. Make sure you stay with us to the end because there's really important information in here. Now, some people say that the difference between the rich and the poor is money, and I refute that. The difference between the rich and the poor is knowledge. There are plenty of rags to riches stories in Australia, and there's no reason why you can't make your own story. If you know what to do with your money, then you will make the right decisions and you will be wealthy. So that's what this webinar is all about, and it's all about property. It's my passion. Thank you for joining me, and let's move on. Okay, keep calm and invest in property. Many people have been stung by various investment schemes, the Storm Financial Crisis, Timber Corp, all these different things. But one thing that has stood the test of time in Australia has been property, as long as you stay in there long enough. And the name of the game is not necessarily to buy property, but it is to hang in there and buy time. The longer you stay in the property market, the more chance you've got of being successful. But of course, we're going to talk about, in this webinar tonight, my mantra, which is to buy where it's booming. We're going to talk about how to know where it's booming and then what to buy in those locations. If you don't buy where it's booming, you're not going to make any money. You're not going to be able to access equity and buy more properties and build your portfolio. We'll talk all about that in this webinar this afternoon. Okay, all morning or night, whatever time you're watching this. So this is what we're going to talk about. We're going to talk a little bit about me. Now, that's not to blow my own trumpet, but just so you understand where I'm coming from, how I got to where I am now, and just so when I'm talking to you about all this other stuff, you have an understanding of my experience and how I came to conclude the things that I'm going to teach you about in this webinar. We're going to talk about the dirty tricks that get played on people like you in the property investment industry. You know, you go to these seminars in the big inner city hotel conference centres, and someone gets up on stage and says all these amazing things about property, but then you find yourself running to the back of the room to sign up for their program and then having a very negative experience, being really let down and not being delivered on what was promised. Look, I'm going to talk to you a bit about that. I've been in the industry. I know what goes on, and I'm going to show you some things that may be a little bit shocking, but the important thing is that you understand how they all work so that you can avoid being suckered into those various schemes. We're going to talk about the truth about property statistics. What has actually happened in Australia with house prices? I'm going to show you some evidence, and I'll show you the references for it as well, about, you know, does property really double in value every 7 to 10 years? I'm going to show you the truth about that, and we're also going to talk about, you know, what factors drive property prices up, what factors drive property prices down, and so on, so you can look for those factors and make sure you make the right decisions. We're going to talk about my system for accurately identifying hotspots, where to buy, and then also how to find those elusive positively geared properties. Now, smart investors know that your property portfolio must pay for itself. If not each individual property, across the board your portfolio must pay for itself. And to do that, you need positively geared properties. You need properties with high rent returns, and those properties are out there. Yes, some are in mining towns, and yes, some are in other areas. But there's a few key factors that you must know so that you can find those properties and also pick the right ones that aren't in one of those towns where if the local economy goes down, you're going to lose big time. They are out there. I'm going to show you how to find them and know the difference between a good one and a bad one. Just like any other pursuit, property investment is not any different. If you know what you're doing, you're going to do really well. If you don't know what you're doing, you're going to make mistakes. You're going to buy in the wrong areas. You're going to buy the wrong sorts of properties. You're going to structure incorrectly. You're going to get the wrong finances, and you're going to come to a grinding halt. So we're going to show you the secrets to success. It sounds a bit corny, but it's true. We're going to show you what the top investors know and what you don't know, so that you can then be a top investor yourself. We're also going to show you how I avoid paying tax and how you can too. A lot of people have no idea really how our tax system works. I'm going to show you a real quick and simple diagram that explains how it works so that you can make informed decisions about your property acquisitions as to what effect they're going to have in your tax situation, and get you to the point where if you're not already there, where you're not paying tax anymore, let's face it, I'm sure you've paid enough already. I'm going to also talk to you about the top 5 rookie mistakes and how to avoid them. And at the end, where to go for more help if this webinar doesn't fix the problem you want to fix. Okay, so let's get on with it. All right, about me. There's a particularly bad photo of me. I'm the second guy from the right. That's when I had hair. But the reason why I show this image is because I grew up in a family, 4 kids and a single mother. And we grew up in a little town, little suburb of Campbelltown in New South Wales. I now live in Brisbane, but I grew up in the western suburbs of New South Wales. And it was a very working class environment. A lot of people didn't have any money. And the one thing I learned there was that the people who work the hardest aren't necessarily the people who make all the money. It's the people who work smart that make the money. The people who educate themselves on how to grow wealth, then go forward, and when they do get money, make the right decisions with it and build their wealth. A lot of other people, they just waste their money and they don't know what to do with it. It's knowledge is the difference between the rich and the poor, as we spoke about earlier, and that's something I learned very quickly. And I thought, I've got to get out of here. I've got to get away from all these negative thinking, poor-minded people. When I say poor-minded, I mean they think like poor people, and get a start. So what I actually did was I ran away and joined the army. And I got into this place here, which is the Royal Military College Duntroon in Canberra. And this was a real formative experience for me, really whipped me into shape, and a very interesting place. It was here that I adopted the principle of integrity. I'm not a very religious person, but I believe that the core value at all religious structures is this value of integrity, where not only should you tell the truth, but you should also always act in the best interest of all concerned. You shouldn't be deceitful. And the reason why they teach you this at Duntroon is because they're actually training people to lead soldiers in war. And that's a really serious business. And if you're not someone whose integrity is absolutely unquestioned, then you're not going to be a very successful leader, because the soldiers won't trust you and they won't follow your orders. So anyway, it was at Duntroon that I got a start, and I learned this value of integrity. And I'm shocked to this day at how many people in the property investment industry just do not value integrity. Look, even if you think I'm full of it, when I say that integrity is important to me, you'll at least accept that it's just good business to have integrity and to be straight with people and completely honest and open in your dealings with everybody. Because if you do that, people will trust you and they'll keep coming back to you. I then went on to enjoy a career of 14 years in the army. In that time, I served in East Timor. Now, there's me in East Timor. That day we were looking for some ex-militia bad guys, but the reason why I show you that slide is because soldiers who go overseas actually get paid deployment money. It can be anywhere from $150 to $250 a day on top of their wage, which is tax-free. And after the average tour, they can come home with anywhere from $50,000 to $80,000. And that is how I got my start in property investment. I was able to buy my first house, and it was quite an opportunity that, unfortunately, for some they don't get. Other people just have the good old-fashioned way and save to get there. After East Timor, I bought this property here. Now, this is an after photo of a renovation. Now, it looks like a very presentable property, but actually, that property was a disaster for me financially. See, I was one of these young guys who thought he knew everything and thought he could do it all on his own and work it out himself. And I can tell you now that is really, really foolish. Now, we bought that property at the wrong time. We bought it at the height of the market. We tried to renovate, and look, the renovation made money. We put 20 grand in, and we increased the value by 40 grand. However, when you consider the entry costs, i.e. the stamp duty on the way in, and the exit costs, and that's the agent's commission, any profit was wiped out. And also when you consider the holding costs, paying the mortgage during the renovation and what have you, we actually lost money on that property. And a lot of people make this mistake. And it's not a minority, it's a majority. People go in blind and they buy locally. We bought that property locally. We used the first homeowners grant. Whoopie-doo, $7,000. It doesn't mean jack when you consider that you could just go and buy where it's booming and make 50 to 100 grand capital growth in the space of 12 months, which I have done and my clients have done. A lot of people go and buy locally, they buy the wrong sort of property in the wrong place, and they lose out. And at the end of the day, they only have themselves to blame, because property investment is a form of investment just like any other. And if you don't know what you're doing, you are going to make mistakes. And I made all those mistakes. After making those mistakes, I thought, look, enough's enough. But fortunately, the Army sent me overseas again, and this time I went to Iraq. And as you can see, my hairline progressively receded over the years. But Iraq gave me the second chance. And I got a lump sum of money after Iraq, and I then decided that I wasn't going to waste it. I then put myself on a 2-year journey where I read everything that was ever written about Australian property investment. I went to every seminar I could find. Whatever I could get my hands on, I consumed it and got myself into, I finally cracked the code, as I often say. I finally worked out the system. And the system I've already touched on, it's to buy where it's booming and to make sure your properties pay for themselves. Once I worked that out, I did extremely well. So well, in fact, that in my last year in the regular Army, I was a major in the Army by then, so I was on about 120 grand a year total package, when you include all the benefits. But in that same year, I made $260,000 in capital growth on my investment properties. So if you know what you're doing, then you can work that out. And that's what happened after Iraq. I then started to have enormous success, and I started to build my portfolio quite rapidly and started making a lot of money, and it was fantastic. Okay, so my success started to get noticed. 2 young children decided that going overseas on deployments and getting shot at wasn't going to be much fun anymore, and that I had a responsibility towards my kids. And then I got offered a job in the property investment industry, working for a company that shall remain nameless, but working for a company that, and they did give me a great opportunity, and I learned a lot working for them, but I learned also about what not to do. And that's why this slide is black, because there is a dark side to the property investment industry that a lot of people don't understand, and that's why you get suckered in. Now, quite simply, if you're ever going to deal with a property investment company, the first thing you want to find out is whether they are a real estate agency or not. Now, 95% of them are licensed real estate agents, and you would think that's a good thing, but actually it's a conflict of interest. See, a lot of these guys are just smart real estate agents who are selling a lot of property, and the way they do it is this. Some people think that being a real estate agent is all about selling properties. Actually, though, that's only half the job. The first half of the job is getting the listings in the first place, finding owners, builders or developers who will let you sell that property for them. Now, if you're smart, you'll realise very quickly that the best thing to do is to court developers so that you can get 100 properties to sell in one phone call, rather than trying to get them one by one from mum and dad sellers. So a lot of these companies are just doing that. They're courting the developers, getting lots of listings, and then on the flip side, they think, who are the best people to sell to? Investors. Why? Because investors buy multiple properties. Investors are less emotional about the property. Investors don't care whether the fridge cavity is big enough for their fridge or not, and things like that. And so that's what they do. They set themselves up basically as a real estate sales machine. And they run seminars with information very similar to what you're going to hear tonight, but then on the tail end of it, they'll sell you one of their properties. And that property won't necessarily be in Australia's #1 place to buy property. It'll be in the place that they've managed to get listings. And that's really important to understand. Now, I was working for a company. I had a real problem with some of the stock that they were selling to the clients. And I went to the boss and I said, look, I've got a real problem with this. Some of this stock really sucks, and I don't think the client's going to make any money. And I was told, Daimien, just act in the best interest of your clients. Give them what you think is the right thing to do. So I said, fantastic. I started steering all my clients towards the best properties the company had. Within 2 weeks, I was brought back in and told, Daimien, you've got to stop selling all the good stock to your clients. And I said, well, why? Isn't that what we're supposed to do, act in the best interest? And they said, well, no. And I got told very matter-of-factly, they said, what you have to understand is the commercial reality is that we are provided stock by the developer, and the developers have good stock and they have bad stock. And if you don't move their bad stock for them, they won't give you any good stock. So we need to get some of this other stock out the door. And boy, was that like getting smashed in the face with a sledgehammer. And for me, an ex-army officer who's very strong, centred on values and integrity, I just couldn't do it. That was the beginning and the end of me. But then I realised that there was a better way. So I then went out and started the company that you see here, Integrity Property Investor Services. And what we are is we're an independent boutique property advisory coaching strategy company. Okay, and what we do is we help people to be successful investors, and we have a team of experts involved with us. We have accountants, financial planners, mortgage brokers, building inspectors, you name it, we've got it, conveyancing solicitors, quantity surveyors, rental managers, got them all, and we put that team around our clients and make sure our clients are successful, and I stay with them the whole way. But we're not here to talk about the company tonight, we're just here to share this information with you. So, but that's me, that's where I'm coming from, that's my journey so far. So let's get on with the stuff that you can benefit from. Okay, so why invest in property? Now, we all have our own reasons for investing in property, but look, if you're thinking about just money, then it's not about the money, because investing in property does have risks, and you can manage those risks, and you can do very well, of course, but it does have risks. If your goal is just to increase your bank balance, then you're probably not thinking about things the right way, and ultimately you won't be motivated enough. But here's the thing, are these things evil? Is educating your children evil? Is getting the very best healthcare for yourself and your family, touch wood, you should not ever need it, but if that did occur? Is travel evil? Is supporting charities evil? Is having the odd recreational toy for a bit of fun and quality time on the weekend, is that evil? And is spending more time with your family evil? Now, the one thing that all these things have in common is you need money to do them. So money itself is not the goal. These things are the goal. But the common denominator of all these things is money. So we need to devise ways to get money in order to do this. And even spending time with your family, spending more time with your family, well, what do you need? You need money to do that. You need to work less. And the only way you can work less is if you've got passive income coming in from another source other than your wage. Okay, and that's what property investment's all about. Okay, quick question for you. Write this down on a piece of paper right now and be honest with yourself. Okay, this is really, really important stuff, and if you're not taking it seriously, do yourself a favour and take it seriously. Now, here's the question. If you've got 20 years left to work on your current income, how much of that income do you need to save so that you can maintain that income in retirement? What percentage of your current income should you be saving if you've got 20 years left to work in order to retire on the same income you are on today? Okay, now the answer is 42%. Hard to believe, and that's if you've got 20 years left to work. A lot of people have only got 5 or 10. And here's the thing, it's really scary. But there are actually people out there doing exactly that. There are couples who are both working and saving one income, living off one income and saving the other in order to get to retirement and so they can retire on decent money. It's a real serious situation. The pension is not what it used to be. Once upon a time, the government was going to pay you a pension when you're retired and you'd live happily ever after. That is not the case anymore. It's up to you now, and you must take it seriously. Otherwise, by the time you retire, you're going to end up with nothing. Okay. All right, interesting statistic. 92% of retirees are currently living on less than 15 grand per annum, which is basically the pension. Now, can you see yourself living on that sort of money? If you can't, then you need to take this stuff seriously. Now, interestingly enough too, I'm a veteran myself, and I got a total, I think, add them both together, I think I got 60,000 on the first tour and 80,000 on the second. But I've met veterans who've done more tours than me and are now flat broke. Why? Because they don't know what to do with their money when they get it, and then they just waste it all. And this is what we're trying to avoid. This is what tonight's all about. Okay? All right, here's another interesting statistic. This came out a few years ago from the Australian Bureau of Stats. But what they basically said was that if you took 100 15-year-olds today, who by the time they're 65, 27 will be dead, 49 will be dead broke, 16 will have an average income of $390 a week, 7 will have an average income of $520 a week, but only one of them will have an income of $800 or more. Now, pretty much everyone who watches this webinar is at least on that money, $800 per week. $800 per week is not a lot of money. It's what, 40 grand a year. So this you need to take very, very seriously. All right. Now the truth is, we need to get real with ourselves now. And the truth is, we spend half our life buying things to impress people, buying things we don't really need, like jet skis and the like, to impress people we don't really like. Now, who are you trying to impress at the expense of your financial future? Are you putting the horse before the cart? Why not take a couple of years off, buy all the crap, put that aside, and invest in your future? And if you're already doing that, well done. But if you're not, enough's enough, okay? Go back to being cool in a couple of years' time when you've got 4 or 5 investment properties under your belt, and you can justify it then because you've got assets making you money. If you don't have assets going up in value, then don't waste your money on things that go down in value. Okay. Are they really worth it, whoever you're trying to impress? Chances are they're not that impressed anyway. Okay. Now here's the question 2. How long would you survive if your income stopped today? And that's a really important question. If you don't have income protection insurance, you most certainly should be taking care of that. But quite simply, if you could have a vehicle accident tomorrow, again, touch wood, that doesn't happen. But if you had an accident tomorrow and you couldn't work, what would happen? And what is your plan to fix that? Okay, great. Now, the problem with a lot of this stuff that I'm going to go on with is you've never heard of it before. And the reason you've never heard of it before is because people get taught their financial skills from their family more often than not. And the problem with that is that 9 out of 10 of us aren't that wealthy. In fact, 9 out of 10 of us live week to week, paycheck to paycheck. So there's every chance that you got your financial education from the very wrong spot, and that in your head, though, all these ideas, all these mental models, all these beliefs that are probably false. Now, the mind is like a parachute. It only works when it's open. So what I want you to do now is put all that baggage aside and say, you know what, just for the next 45 minutes, I'm going to listen to this bloke, and I'm going to see what he has to say. I'll put all my preconceived ideas and I'll give these theories a go, because, if I don't, I'm going to keep getting the same result I've been getting today. All right. The question is, why don't you already have what you want? Why aren't you already retired? If you're 30, you've had 10 years at it. Look, I'm over 30, and I'm not retired, but I'm a lot closer to it than most. But the reason is because we didn't have the education. I didn't get my education until my late 20s, but there's never too late to start. Okay, the reason why you haven't got what you already want is because of these limiting beliefs and obstacles. And let's talk about them now. I don't have the cash for a deposit. Believe it or not, you don't actually need cash to buy properties. Certainly the first one you often do, and there are some schemes where you can buy no money down properties. Unfortunately, I haven't found one yet that where it's in a good location, and that's the flip side. You might get a no money down property, but then it may not make you any money. You might not grow your portfolio anyway. But look, the first property, let's face it, you need cash for that. But after that, you don't, because after that you'll have equity. And we'll go through that later and show you how that works, but you can basically just use the bank's money to buy more and more property as the years go by. I had a client who'd come to see me. Before they met me, they had bought 4 properties and paid cash deposits every time. God bless them, they had saved up, not for 1 property, but for 4 properties. But yet they had heaps of equity in their portfolio, and no one had ever bothered to tell them that they didn't need to waste their cash on buying properties. They could have just used equity. Okay, we're not rich people. Some people just have resigned themselves to the fact that they were born into a poor family and they weren't born with a silver spoon in their mouth, and they're never going to get ahead. Some people have convinced themselves that they should be happy if they manage to pay their house off. Now, that is again wrong. As I said earlier, there's plenty of rags to riches stories in Australia. The difference is knowledge, and no one teaching this stuff except guys like me. So keep paying attention. Okay, I'll end up with tenants from hell. Some people believe that if they buy an investment property, they'll end up with a tenant who's got 5 cats and 2 dogs and a horse and a budgerigar, and they'll trash the place. Now, quite simply, okay, if you think that's the case, you're probably watching too much of Current Affair Today tonight. The reality is most tenants are very, very good tenants, and that, look, the way to avoid tenants from hell is really simple. If I'm a tenant from hell, I'm a tenant from hell because I have a lack of respect for authority and a lack of respect for other people's possessions, i.e. their house that I'm renting off them. Now, those sorts of people, if they have that quality, guess where they're living? They're living in the poor end of town because those same qualities would transfer to their workplace and their career. So quite simply, if you want to stay away from tenants from hell, stay away from the cheaper properties and go to the middle of the market. If you stay away from the lower end of town, you'll avoid property. Now, say this very carefully, poor people aren't necessarily bad tenants. Of course, the great majority of them are good tenants, but all bad tenants are poor. Okay? And then also, on top of that, you get your landlord's insurance. So if the worst case scenario does happen, you just claim on your landlord's insurance, get it fixed up and move on. Okay, I may lose my job. Some people believe that they can't afford to buy an investment property because they might lose their job and not be able to afford to pay for it. Well, the first point I'd say to you is your property's not paying for itself. You shouldn't be buying the bloody thing, first and foremost. And second of all, most people get too comfortable in their current job and they don't realise that they could probably do better if they looked elsewhere. So, sometimes it can be a blessing in disguise losing your job and moving on to something else. Also, good property investors will maintain a cash buffer, so they've always got cash in reserve if they have to cover a gap, and they will also have landlord's insurance, which will include prolonged vacancies, so that they can cover that as well. Okay. Interest rates will go up. In particular, people who lived through the recession in the early 90s are really worried about interest rates going up. And look, I guarantee you one thing, is that interest rates will go up. I also guarantee you that they'll come down again. Interest rates are a roller coaster ride. They go up and down. Smart investors make sure they've got a cash buffer to deal with that. Okay, so make hay when the sun shines. When the rates are going down, they're putting money aside into their buffer, and so that if interest rates do go up, they can absorb that blow. Also though, there's a key point of difference between now and the recession, and that is that the Reserve Bank is independent. A lot of people don't realise how it works. The Reserve Bank lends money to the banks, and then the banks lend money to you. Now, the Reserve Bank rate is 3.5% at the moment, at the time of creating this webinar. Now, the banks then lend that money to you at, say, 6%. And that way, they make their margin. Now, here's the thing. If the Reserve Bank puts the interest rate up, that flows through to you as well. But what happened once upon a time is that the Reserve Bank was not independent. Now, the Reserve Bank interest rates used to be politicised, and governments would get elected, and they put the Reserve Bank interest rate up so that they could recoup money and pay their bills. Now, that's no longer the case. The Reserve Bank is independent, and it has a mandate to keep inflation at 2 to 3%. So on the first Tuesday of every month, the Reserve Bank Board meets, and they review the current inflation rates. If inflation's going up too high, the Reserve Bank will put interest rates up. If inflation's low, they'll put interest rates down in order to stimulate the economy, because obviously if they put interest rates down, that'll flow through to the mortgage holders who have more disposable income. If they put interest rates up, that'll again flow through to mortgage holders who have less disposable income and spend less. So they use that as a mechanism to keep the economy strong. And that is why the Australian economy is so strong. That's why the Australian property market was fine, and that's why Australia did so well through the global financial crisis, because of the independence of our Reserve Bank, who are the real heroes of the global financial crisis for Australia, not Kevin Rudd and his mates giving everyone $900. Okay, some people believe that if they personally invest, the market's going to crash. Their personal involvement in the property market will make the whole market crash, and it'll be all their fault. Now, look, if you think the property market's going to crash, do not invest in property, for God's sake, because you will not sleep at night. But ask yourself this: if the global financial crisis was not an acid test on the Australian property market, what will be? The Australian property market survived that. Surely it will survive anything else we can throw at it. Okay? The reason why we survived it is because our lending practices are much more conservative, our economy is much more diverse and stable, and it's a great form of investment. Okay? All right, so how to think like a successful investor. Now, everyone sits around at home saying, oh, honey, what would we do if we won the lotto? Now, ask yourself this: if you won 500 grand in the lotto, what would you spend it on? would you spend it on? Now, most people would say, other than spend a little bit on a holiday or maybe a new car, most people would say to pay the mortgage off or buy a house outright. And that sounds like good advice. My father would say that actually. He's totally different to me. But guess what? He's retired and he's still got $100 grand mortgage on his house and he has no passive income. But most people would say that. Now, if you went and did that, let's just see what would happen. Okay, the most expensive house you could buy at 500 grand would be 480 because you'd have stamp duty and you'd need to pay that stamp duty. So 480 is as good as it gets. So let's see what would happen if we did that. Over D years, we'd end up with $960,000 worth of house. Now D is D for double. So now we know historically in Australia, we know that in the 70s house prices they quadrupled, believe it or not, and I'll show you the stats later. In the 70s they tripled. In the 70s they quadrupled. In the 80s they tripled. In the 90s they doubled, and last decade they doubled as well on average across the country. Of course, there were areas that did far better than that, and there were also areas that did worse than that. But the average was in accordance with that. So let's just say that D is 10 years, and because we didn't have to pay for a mortgage, let's say we saved 200 grand. 20 grand a year in savings. Our net worth is 1.16 million. Now look, that's not bad. And it just goes to show that even an idiot can do well in property, because if you hang on to it long enough, you'll do okay. The problem with this scenario though is that you cannot retire. 200 grand won't last very long at all, and you can't access the money that's in your own house because that money is needed for your house. So you can't take out a mortgage in retirement. Okay, let's see what a property investor would do. Now I'll stress to you, this is what a conservative investor would do. Conservative investor would go and buy 4 properties, okay, $500,000 each for easy math, $100,000 deposit with a $400,000 loan on each property, okay. Now remember, we won 500 in the lotto, so put 100 grand deposit on each, that's 400 grand. 20 grand costs on each, that's 480, and leave 20 grand in the bank as spare change, as a buffer. Okay, so the portfolio starts at 2 million. They've got 1.16 million of good debt. Now there is a difference between good and bad debt. Property investors love good debt. They sleep very well at night with their debt. And basically the definition is this: good debt is debt that's used to buy assets that go up in value, like real estate. Bad debt is debt that's used to buy assets that go down in value, like cars and jet skis, etc. So in this situation, we start off with a net worth of 400 grand, plus the 20 grand or so we had left in the buffer account. Okay, live in the first property. Don't save as much money as we would have by owning our own home. Rent the other 3 out. And if those 3 investment properties, this is a worst case conservative scenario, if those 3 investment properties were negatively geared by $100 a week, then they must cost $600 a week each to hold, because the $500 a week rent is $100 short of meeting the cost. So therefore, we're receiving $1,500 a week in rent, but we've got costs of $1,800 per week, so a net income of minus $300 per week. We've got to chuck that in. Now, why on earth would you do that? That sounds absolutely ridiculous. But property investors do that because they understand one thing. They understand what's going to happen in time. Let's look in the same period, in D years, let's look at what would happen. Now, those properties would double in value. So we would have 4 $1 million properties. Now, the mortgages, well, worst case scenario for those mortgages is that they haven't changed. They haven't gone down. That's interest-only loans the whole time. 10 years later, we still own the same money. But also, you'll see the values have doubled, so have the rents. Let's see what happens. Portfolio is now worth 4 million. Now, the good debt situation hasn't changed. It's 1.6. Now, when I went to school, 4 minus 1.6 was $2.4 million, which is a lot better than the $1.16 million we had by buying a property outright. So we're multi-millionaires by taking this course of action. Okay. Not only that, our rent has now doubled as well. So instead of being in a negative situation, we're now in a positive situation, $3,000 a week. If holding costs have gone up with inflation 2 to 3% per annum, we've got $2 grand in holding costs, net income, $1,000 a week. And now you can see how property investors start to retire. If you look at that, if you then extrapolate that to the right, another double cycle, Do the math then. Portfolio would then be worth $8 million. The good debt would not have changed, 1.6. We're now worth $6.4 million. The rent's now $6,000 a week. If the holding costs have gone up to $3,000, we're now netting $3,000 a week rent. So the good thing about a property portfolio is it's like a fine wine. It just gets better and better with age. And as you retire, you keep making more and more money. Now, some of you might also be saying, that's well and good, Damien, but you've still got a debt on your own home. And that's very, very true. And let me show you now the quickest way to pay a house off. The quickest way to pay a house off is to not slug away at the mortgage. The quickest way to have a house, pay a house off, is to get investment properties. And then, see this property here, first investment property? The bank will allow you to increase that mortgage up to 80%. So you take it up to $800,000, you increase it by $400,000. That's okay because the new rent of $1,000 a week is going to cover that on the surplus rent of the 3 properties. And then we take that $400,000 from here and we use it, and in a single day we wipe out our mortgage. In a single day we wipe out our mortgage. That's how you pay a house off, ladies and gents. That's how it's done. That's the smart way. That's what property investors do. We don't slug away at it for 30 years. Okay, now that's all well and good, but what we said at the start was that you had to win the lotto to do that. Now some people think, oh, well that's no good, I haven't won the lotto. But actually if you sit and think about it, you may well be not far off 500 grand. If you think about how much equity you've got in your home, how much money you've got in super, you may well be more closer than you think. And you can now, through self-managed super funds, buy property with your super. So it is possible. But if you did have to start from scratch, then let me tell you how you can get to a $2 million portfolio and larger in a short period of time. Now people say to me, if I had to start again, what would I do? And this is what I say, quite honestly, I would move into a caravan park, I'd rent the cheapest thing I could find, I'd get a full-time job and a night job, I'd live on Weet-Bix, cheese sandwiches and 2-minute noodles until I had enough money to get that first investment property. And then in that time I'd be doing all the research in the world to identify the place that's going to boom. And then I'd go there and I'd buy a property. Okay, and then once I've done that, once I've got that first property, then I'd quit my night job, move into a normal house again, start eating normal food again, and move on. But let me show you why. Let's say here we buy a $350,000 property and we get a mortgage of 280 grand. We buy that property somewhere it's booming. Let's see how we grow the portfolio now. Okay, let's say the property over a couple of years goes up to 500 grand. What's now happened is that the loan, which is no change, is still 280 grand, but it's actually now less than the 80% line. So we now have a space between that, which is what we call available equity, and we can go to the bank and get finance from the bank to access that money. Okay, so in this case, there's up to 120 grand available there, and some banks will even let you go to 90%, so there's even more money. Okay, we then go to the bank, the first bank, and we ask for a second loan, and that's an investment loan, tax-deductible loan, and we take the money from that 120k loan. The reality is it probably only need to be about 100, and we use it to pay the depositing costs on the second investment property. We'll do the same trick again, $350,000 property, 80% mortgage, 280. So put about 100 grand in there to pay the 70 grand deposit and then some costs, probably more like 90 grand. Okay, so one property has given birth to a second. Now we just replicate that process. Time will continue to go by and the first property will give birth again to another property. But so will the second one. And one property became 2 and now 2 properties have become 4. 4 will then become 8, 8 will become 16, 16, 32 and so on. And now you can start to understand how my mentor, by the age of 58, had 76 properties and he started when he was 30. Okay, property grows exponentially. In the early days, it's years between purchases. In the later days, you can't buy property fast enough. As long as you structure it correctly, make sure the portfolio is paying for itself, you can keep going and going and going and going. Okay? Much like Monopoly, 4 green houses and then a red hotel. And you always wonder about these people who buy entire apartment blocks in one foul swoop. They're the people who are right into it, right down the track and have so much equity in their existing portfolio that they can just go and buy entire apartment blocks and rent them out. Okay, so how to stop paying tax. Okay, a lot of people don't understand the tax system, how it works in Australia. And I ask people, I say, so what's the, how much tax are you paying? The good one is when people say, I don't want a pay rise because then I'll be in the next tax bracket and I'll have to pay more tax. I mean, we have a marginal tax system in Australia. It doesn't work like that. You get taxed in brackets. Okay. Now, as of 1 July 2012, there are new tax brackets, and here they are on the screen. Okay, the first 18,000, no tax. Up to 37,000, you'll then pay 19%. Up to 80,000, you pay 32.5%. 80 to 180, 37, and then obviously 45 on every dollar above that. Okay, so how does an investment property stop you paying tax or reduce your tax? I'll show you. Let's say you're earning 100 grand a year, either as an individual or as a couple. Okay. Now the first thing that will happen is they'll actually add the rent to your income. A lot of people don't realise that the rent you receive for a property is actually on paper considered income and can be taxed. But don't be alarmed, because obviously we've got the deductions to take us back in the other direction. But here's the point to note though. If you pay all your properties off and all you're getting is rent and you don't have expenses to claim, then you should be expecting to pay tax on that income. Okay, so that takes our base taxable income up to $118,200. Now though, let's look at the deductions. Now there's two types of deductions. There's cash deductions and on-paper deductions. Loan interest at 7%, $19,600. Rates, 2 grand. Rental management, $1,365. Insurance, $1,000. These are what we call cash deductions. You actually have to give someone money in order to claim these deductions. Now, so money actually leaves your account, and of course you don't get it all back. You just get 37 cents in the dollar back, or whatever tax bracket you're in. But the real money for GM with properties is in what we call depreciation. Now, and this is why it's so important that you buy new properties. See, the government allows you to have on-paper deductions to claim the depreciation of a property. You could have two properties side by side. A lot of people don't realise this. You've got two properties side by side. One's brand new, one's 25 years old. They can both be worth the same amount, say 400 grand each, but the one that's brand new is going to cost you less to hold as an investor, because you've got to get a big fat tax return from it based on the depreciation. Let's show you how that works. So our taxable income is now being reduced by 33, almost 34 grand. And our taxable income is now 84 instead of the original 100 grand that we paid tax on. Therefore, if our original 100 grand income minus our taxable income means we paid tax on 15 grand more than we should have. Therefore, we get 37 cents in the dollar back. And for one investment property, we can see there we've got 6 grand. Now, I have properties that get me more than that. I have some properties that get me less than that. But either way, this is how it works. And obviously, the more properties you got, the quicker you're going to wipe out your tax. But the real value is in depreciation. Okay, negative versus positive cash flow and gearing. A lot of people don't understand. We hear all about cash flow and gearing. Cash flow is before tax. Cash flow is week to week. Gearing is after tax. Okay. So how much does a property cost you after tax? Now, money and time, a bit like high school maths class. Okay. Costs will go up with inflation, 2 to 3%. Insurance, rates, and the like. However, rent will do this. Rent will double in value in accordance with, every 10 years or so, in accordance with historical trends. Okay. Now this period here is the negative gearing period. This is what I also like to refer to as the hurt locker. This is where the naive investors who buy locally in the 9 out of 10 parts of the country that are negatively geared with a 90 or 80% mortgage, and they end up forking out $100 a week, and it starts to hurt them. They start wondering why they can't go out to dinner or the movies anymore, and then they sell the property prematurely. But the thing to note about this period here is it comes to a definitive end. It comes to a definitive end. It will end. As the rent goes up, it will end. And then you'll be into this space, positive gearing or positive cash flow. Okay? And the thing to note about this is it doesn't end. In fact, it just gets better and better and better. Your surplus rent gets better and better and better. So can't you see the name of the game is just to get past the break-even point. If you can get past that point, then you're going to do very, very well. You're going to be able to buy more and more properties, and you're going to be able to retire early. Now, smart property investors won't even play in the hurt locker. They will start at the break-even point or in a positive space. They'll go and find positively geared properties and buy them instead, because you can have one negatively geared property or you could have 4 positives. It's really up to you. Okay, now the key point to note is cash flow is before tax. So if you're going to go and get a 10 grand tax return, okay, cash flow does not take the tax return into account. It's just money in and out of your account week to week. Gearing is when you consider the tax return, okay? So it is possible for a property to be negative cash flow but positively geared. For example, if you've got a property that is $50 a week negative cash flow, i.e. the rent you're receiving is falling $50 a week short of paying the bills, but then you go and get a 5 grand tax return, well that's $100 a week and then you're $50 in the positive after tax, okay? So it's important to understand that, and when you're weighing up whether a property is suitable or not, ideally you just want to look at the gearing factor, because cash flow, you can deal with that using your buffer, but as long as after tax you're back in positive space, then you're home and home. Okay, and then here's the $1 million question. Will house prices keep going up? Now, this slide is deliberately tongue-in-cheek. In 1960, here's a map of Australia, what Australia looked like in 1960. The population was 10 million. In 2010, here's a map of Australia. No different, but the population is more than double. Okay? Same land, more people. As long as the population of Australia keeps going up, then so will house prices, mark my words. Okay? And we'll show you the stats in a second. As long as the population keeps growing up, well, so will house prices. They will go up far in excess of inflation. Okay? Now let's look at those historical data. Now imagine this, it's 1970, we're in Brisbane, and I say to you, whatever you do, don't sell that house of yours because it's going to quadruple in value in the next 10 years. Quadruple in value, you say? You're crazy, Daimien. That's not going to happen. Well, it did. It went from, the median house price in Brisbane went from 8.5 grand to 34.5 grand. Okay, and you can see there the source there, Real Estate Institute of Australia and RP data. Hard to believe, but true. Now in the 70s, there was a resources boom, and there was massive wage growth in the country. And there is massive wage growth going on in the country at the moment, off the back of the resources boom, but it's not happening in the manufacturing sectors and places like that. It's happening elsewhere. Now, imagine this, it's now 1980, and despite your scepticism, your property did quadruple in value, and you're now sitting on a $34,500 property, and you're amazed how it happened. Okay? I didn't say to you, look, don't sell it because in the next 10 years it's going to triple. You go, oh, Daimien, you're crazy, that's not sustainable, it's not possible, but it did. And as you can see, it's consistent across the board. Okay, house prices continue to grow. In the 90s, when we had the recession we had to have, what do you think house prices should have done in the worst recession that Australia had in many, many years? Well, you wouldn't have thought they'd double, but yet that's what they did. I mean, look at pretty much that's what they did. A little bit short of double in some cases, but that is what they did. And they continued to grow and grow. And they will continue to grow and grow because same land, more people. Okay. Now here's the data from Melbourne. You'll see there, this is sourced from Residex, and this slide's a little bit old now. 2008 was when it was created. But the interesting point to note here is here's all the great financial depressions or financial events in Australia. The 1890s, World War I, the Great Depression, World War II, the Menzies credit squeeze in the 60s, and the recession in the 90s. What happened between the Menzies credit scheme and the recession in the 90s? Massive boom. What happened after the 90s? Massive boom. So as you can see, even during World War II, house prices went up. Wouldn't you think when the country was under the threat of imminent invasion that house prices would have gone down? Yet they went up. And as you can see, 1890s depression, house prices went down a bit at the start, went sideways and started going up again. So as you can see, over time, house prices have continued to go up in value. And sure, it's gone down in value every now and then, And that's what, a good investor will be able to predict that and see that happen, okay, and avoid that, and will hang in there long enough to pick it up again later. Okay, so where to buy? Now, in the Army, I was involved in the targeting and intelligence process, working out where the bad guys were and what we should do, and how we should find them. I'll give you a good example is if you're going to try and find an enemy headquarters, you don't just go and say, oh, where's the enemy headquarters? You actually break it down to another level and you say, okay, where's all the radio traffic? Where's the tents that have all the antennas sticking out the top of them? Where's the place that's laid out in a particular fashion, classic to a headquarters? Where's all the vehicle traffic going to a central point? And then you go and look for all those different indicators and then draw a conclusion of where the headquarters is, and you'd find it. And so then when I got into property investment, I said, well, what's the equivalent of that? What factors indicate an area that is booming or is going to boom? And I came up with this. Now, this is basic high school economics meets targeting, supply and demand. There are 4 factors that drive property prices, and it's taken me a long time to boil this down, but this I'm supremely confident of. Don't worry about whether the house is close to a milk bar and things like that. If you're thinking about that stuff, you're going down the wrong track. When people buy shares in BHP, they don't say which bulldozer is mine. They're just buying shares in BHP. And the same thing should go for property investment. You're not buying a house. You're buying shares in the town. If one house goes up in value, they're all going to go up in value. And their prices are relative to the features that they have. So don't buy property based on features. Buy property based on where it's located and whether that suburb or that town is going in there. Now the 4 factors are lack of land, lack of tradies, increase in population and increase in average wages. Now, lack of land. If there is a lack of land, just like any other commodity, prices are going to go up. For example, cyclone hits Queensland and wipes out the banana crop. What happens to banana prices? They go up. Why? Because there's less of them. So if you have a lack of land, then the prices are going to go up. Best example of that, quite simplest example, is an island that is already built out, or a peninsula that's already built out. Darwin's a great example of that. Darwin's always had a land supply problem because Darwin itself is built on the tip of a peninsula that really only has a 90-degree arc to grow. Back on lack of land, there are other factors as well though. There might be artificial factors. For example, there are towns in central Queensland that are landlocked by mining leases. So those towns cannot physically grow. The mining companies don't want to release the land because they're mining it. So those towns can't physically grow. So look for evidence of a lack of land and you will find land prices going up. Okay, next factor, lack of tradies. Let's say I'm a builder and I've got the capacity to build 20 houses a year with the staff that I've got. Now if I've got 40 people who want a house built, as a businessman, my natural response is going to be put the price up. Okay? Now old houses are a different equation. They're normally though, the price is set by the new market because builders, it costs X amount of money to build a house and then there has to be a profit margin, otherwise they're not going to build. So new houses drive the prices. Okay? Old houses are usually like second-hand cars. Old houses are priced relative to the new houses. Same as second-hand cars. If I can't afford a new one, so I'll go and buy a second-hand one. Okay. Now, so if there's a lack of tradies, you're going to find that house prices are going to go up because the cost of building is going to go up and therefore the prices will go up and so will the market. Where are you going to find a lack of tradies? Not in places like Melbourne and Sydney where there's a TAFE college on every corner. You're going to find lack of tradies in these regional centres where they don't have the capacity to train the tradesmen that they need. However, they've got these major infrastructure projects going on. So look for evidence of a lack of skilled workers and you will find a place where prices are going to go up. Now on the demand side, increase in population, increase in average wages. Now the best way to think about this is at an auction. Let's say you go to an auction, there's only 2 people there. That house is not going to sell that day unless one of those 2 people is an idiot. Those 2 people, what they'll do is they'll say, well, there's not much demand. They won't bid. They'll wait for the property to be passed in, and then they'll negotiate afterwards. And the whole mood will be there's not a lot of buyers, and the seller will have to lower their price in order to sell the property. Now change that situation now and put 100 people at that auction. The mood changes entirely. They look at each other, they think, wow, this property is popular, the market must be really hot, everyone wants to buy. If I want to buy a property today, I better pay top dollar. And if they don't buy a property that day, they'll buy one the next day when they realise that they're not going to be able to buy something unless they bid high. Now in these towns where you've got a massive increase in population, I'm not talking about birth rates, I'm talking about major infrastructure projects or some other factor that is driving large amounts of people to move to an area. We saw this in southeast Queensland in early last decade when house prices in Sydney and Melbourne got so expensive that there was a mass migration to Queensland from the southern states. But we also see this in some of the regional towns where there are these big gas works and things like that being built. We see massive increases in the population. Now, increase in wages is interesting as well. Same again at an auction. Now, everyone at an auction there's a glass ceiling to that auction. Everyone at that auction has got a number in their head, and that number has been put there by their bank manager or their mortgage broker. That number is basically their borrowing capacity. The bank manager said to them, do not bid over this much because you can't afford it. So regardless of what happens in that auction, regardless of the competition, everyone's going to hit their individual ceiling, and there is a cap to how much that house can be bought for. But if you give everyone in that crowd a $50,000 pay rise, then that ceiling goes up because their borrowing capacities will go up, and they will continue to compete against each other until they hit that limit. Now what happens in a lot of these regional towns is they don't have the tradies they need to build these projects, so they go to places like Sydney, Melbourne, Brisbane, to recruit those people. Now if I'm a young tradie living in Brisbane and I've got a girlfriend and I've got family and mum's home cooking every Sunday night and my usual pubs and things like that, and I'm on 80 grand a year, why on earth would I leave? If you want me to move to some regional town and work on some big project, you better pay me $1. You better pay me a six-figure sum, probably 150. And believe it or not, there are people. I mean, I've got a client who's a crane driver earning 200 grand in Port Hedland. So there are people who are earning that sort of money in these areas. Now these people come to these towns and they get high on the high income and they don't want to leave because they don't want to go back to earning the low income. So then eventually they settle in and then they buy houses and up goes the market because they all compete against each other. So if you look for these factors, you're going to find places to buy. And at Integrity we actually have a dedicated research, one of our staff members is dedicated to researching this every day, looking at what factors are going on in the market, looking at the research other people have done, as well as our own research, and coming up with the best places to buy so that our clients are making money. And if you do that too, then you're going to dramatically increase your chances of success. Okay, so just coming towards the end of the webinar now, and thank you for sticking with us so far. Now, here's the second question. Once you know where to buy, the question is what to buy, and here is my answer. New, middle of the market, residential homes, and here's why. Okay, some people espouse that commercial property is better, but I say no way. The reason for that is the loan value ratios are higher in residential. Now you can buy a commercial property, however, you might get a 1% better rent return or something like that. However, you can't borrow as much money. So you might get 60 or 70% finance and you've got to stump up the other 30 or 40% with your own money. Why would you do that when you can go and buy 4 residential properties with 10% deposits or even 5% deposits if you're really hard charging, and then there's hold more property. Both markets move capital growth-wise in about the same rate. So residential is where it's at, and the reason for that is, as I said, the loan value ratios are better and you can get more assets. Okay, stay away from the high end of the market. It's too volatile and has low rent returns. Why buy a $2 million property anyway when you can buy $400,000 or $500,000 properties and spread your risk across 4 different locations? The high end of the market, a lot of the people, there's 2 types of people in the high end of the market: successful investors or successful business people. Now the successful business people, when the economy takes a dip, so do they, and they end up having to sell their property or something like that, and it can go down dramatically. And I've got a client who had a property, a $3.5 million property in WA, and within 1 year it dropped to $2.5 million. So they lost $1 million in a single year, and that's hard to take, and it's not good as an investor. The other thing is the rent returns as a percentage of the value are very, very poor at the high end of the market. And in fact, a lot of people rent a lot of smart investors will rent a nice property in the high end of the market because it's much cheaper than owning it. And I'm one of those people, as a matter of fact. So low rent returns as well. They're not going to pay for themselves, so stay away from the high end of the market. Okay, the low end, we talked about the low end of the market. That's where you'll find your tenants from hell. You'll also find the low end of the market is usually the older part of the market, so you're not going to have the depreciation that you want. And you're going to have a lot more higher maintenance problems and things like that. So stay away from the low end of the market, as discussed. New properties also have a builder's warranty and low maintenance. So when you buy a property, ideally you never want to sell that thing. You're just going to hang on to it forever and a day, refinance it, sure, but you don't want to sell it. So therefore, longevity is really important. And a new property is obviously going to have lower maintenance costs than an old one, but also you're going to have a builder's warranty when you take possession of it. And when you buy an old property, you never really know what you're buying. You can send a building inspector in there, but you never really know what you're buying. That building inspector is only going to be there for an hour or so, and if you read the disclaimers on the building inspection report, they're really not worth the paper they're written on anyway. At least when you buy a new property, you get a builder's warranty, and when your tenant moves in, you can send them a nice little letter saying, please tell us every last thing that's wrong with the property so that you can get the builder's warranty to fix it, and it doesn't cost you anything. Okay, so it's like getting a new car and having the new car warranty. You've got that peace of mind. Okay, but also it helps your cash flow because you're not forking out to pay for things that are broken. Okay, better tenants. You're going to find better tenants in the middle of the market. Usually that's where your professional couples are, your families who are going to settle in. And look, you don't want a tenant necessarily who's going to be there for 20 years because a tenant who's going to be there for 20 years is not going to be very happy when you keep putting the rent up. You just want, 2 to 3 years and maybe 5, young couple, both working, saving up to buy their own home. That's great. They get to that point, they move out, you get someone in behind them, no problem at all. They're good tenants who are earning good money and can afford to pay for anything they break and always pay their rent on time. Okay? But the most important reason why you buy a new property is, of course, depreciation, because it makes the property cheaper to hold and gets you that big fat tax return. And obviously, the less the property costs for you to hold, the more properties you can buy, and that's the name of the game. Now, he or she who dies with the most property wins, as they say, because if you've got $3 million worth of property and the market moves 10%, you make 300 grand. If you've only got 500 grand's worth of property and the market moves 10%, well, what do you make? You make 50 grand. The more property you got, the better, but obviously they can't all be negatively geared because that all adds up and you have to pay the bill. Property's got to pay for itself, hence why depreciation is so important to help with the cash flow. Okay, if you're going to invest in property, beware of these things and make sure you're being honest with yourself about this, and because only you are going to be the one who fails as a result. Analysis paralysis. I'll let you in on a little secret. There's no such thing as a perfect investment property. No such thing. At the end of the day, a 90% solution today is better than waiting 3 years for the 100% solution because you never will find it. Okay? Just go and get a new middle of the market property. It's going to have a warranty. It's going to be fine. You are going to get a good tenant as long as you're not greedy with your rent. The property is going to be covered by a warranty. Just get on with it. Okay? Don't overanalyze the situation. Worst case scenario, if it doesn't work out, you can sell it and get into something else later. Cut your losses and move. Okay? Be wary of armchair experts. Now, 2 years ago, I had a client whose uncle said to them, I was recommending they buy in a particular place. The uncle said to them, oh, I've never heard of that place. Can't be any good if I've never heard of it. And they were almost not going to buy. That property, they purchased it for $450,000. It's now worth $600,000 within 2 years. They've used the equity in that property and bought another property off the back of that, and that property is already making money as well. Be careful of armchair experts, okay? And there are a lot of accidentally successful property investors out there, people who just bought houses in the year 2000 and 3 years later they doubled in value. But they didn't, not much thought went into it, they just went and bought something and they got lucky. Be wary of the ones who just got lucky, okay? Now look, if your parents are loaded, and caring family, if your parents are loaded, don't listen to me. That's right, don't listen to me. If your parents are loaded, go and talk to them. Say, Mum, Dad, how did you make all your money? Please teach me. Because you can trust your parents, and if they know how to make money, and they've made a lot of money, then they're the best people to teach you because they're always going to be there for you and they're going to make sure you succeed. However, if you're like 90% of us and your parents aren't wealthy, and your parents haven't made a lot of money and you don't want to end up that way, just smile and wave when they give you financial advice because they want to protect you but they don't realise that they're actually probably dragging you down. Okay? Smile and wave and move on. The person to take the advice of is yourself. If you understand what you're doing and you understand the risks and you understand how to find the places that are booming and find the right properties, then you'll be fine. Don't even listening to a guy like me, it's fine. You have to listen to what I'm saying and then decide for yourself whether you agree with it or not, whether you're comfortable with it or not. Okay, then A&I disease. Now A&I stands for arrogance and ignorance disease. It is a disease that plagues many a young person who think they know everything, but they don't. And it is tough to find good advice out there, but if you do it on your own, do not be surprised when you get stung. And I'm not saying that to scare you and trying to force you into doing anything. If you're not comfortable with getting my help, then fine, go and get somebody else's help. But for God's sake, get someone's help, someone who's experienced and someone who knows what they're doing, because they will save you hundreds of thousands of dollars. Okay? If you try and do it all yourself, you'll make big mistakes, and in a year from now, you'll be regretting not taking my advice. Okay, the 5 rookie mistakes and how to avoid them. Mistake number 1, buying nearby. People buy nearby because they want to keep an eye on it. They buy nearby, they say things like this, well, I know my own market. They say, oh, at least I can keep an eye on it. The reality is that a good property manager is going to do far better than you at looking after property anyway, because they're going to know the law, they're going to know what you can and can't do to a tenant, they're going to know the best rent to get for the property, they're going to know, they're going to do their inspections properly and know what to look for. And if you're a part-timer, they're always going to do a better job than you. You're probably, if you try and do it all yourself, you're probably going to get too emotionally attached and end up making the wrong decisions anyway. Buying nearby though, the biggest reason why we don't buy nearby is because we don't want to buy where it's not booming, because we won't make any money. We're talking about hundreds of thousands of dollars doing ourselves out of just by buying nearby, just so we can keep an eye on it. It's a big mistake. Don't do it. Okay, negative gearing. Even the most wealthy person can only afford so many negatively geared properties. Remember, they're called negative for a reason, because they're no good. Okay? Negatively geared properties, unless they're in an absolute cracker capital growth location and you make an informed decision to accept that negative gearing in order to get the capital growth, but even still, you should only ever have 1, maybe no more than 2 negatively geared properties in your portfolio, because any more than that, you're not going to be able to borrow any more money. Okay? The banks are going to look at your servicing and they're going to stop lending you money because all your disposable income is going into propping up negatively geared properties. You want your properties to be positively geared. Okay? And if you don't know how to find those properties and you don't know where they are, then make sure you make an appointment with us and we'll be happy to help you do that. Okay, not using a cash buffer. Some investors, they'll get 50 grand in the bank and they go, you really, I can get another investment property with that. It's a big mistake. What I say to people is have at least 3 months mortgage repayments for every property sitting in a cash buffer, and put that cash buffer, if you're living in your own home, get an offset account or a line of credit or a redraw and stick it all in there, preferably not a redraw, preferably an offset, and stick that money in there and leave it there, because money is the king. If you've got cash, now cash is king, as they say. If you've got cash and something goes wrong, you can buy yourself time with that cash while you sell a property or do something like that. If you don't have any cash and something goes wrong, then you're going to be forced to sell a property quickly, and no one ever sold a property quickly for a good price. Okay, avoid going with the same bank. Avoid going with the same bank. A lot of people don't realise that the most properties you can get with the same bank is 4. Now, if you stay with the same bank, what will happen is, first of all, they'll probably cross-collateralise you, which means all your properties will be tied together, and if you default on one, you default on them all, and they can sell the whole lot. But more importantly, a lot of people don't understand that every time you get a mortgage on a property, mortgage insurance is taken out. Now, some people think that that's only when you go over 80% loan value ratio. That's not true. There's always a mortgage insurance policy taken out. The difference is who pays for it. If you borrow more than 80%, you will pay for the premium. However, if you borrow less than 80%, the bank will pay for it. The point is, though, there's always one taken. And the mortgage insurers will only insure one property per client per bank. And there's only 4 mortgage insurers. So if you stay with the same bank, you'll get to 4 properties and then the bank will refuse you money because they cannot insure you and you will then become too much of a risk for them. Also, the other banks won't want to touch you because they will see that you're overcommitted to the first bank and they know that if you went under, that you would not, they would be the first one you burn because you wouldn't want to burn the bank that's got you for 4 properties, you'd only burn the one that's got you for 1. So always avoid going with the same bank. If you're already in this situation, then come and see us and we can get it fixed for you, but it's going to cost you. It's not for fees that we would charge you, it's going to cost you by the fees the bank would charge you. But look, 2 properties with the same bank is okay. 3, you're really pushing your luck and you probably shouldn't. And 4, definitely you've hit a wall and you're in a dead-end street and you're going to need to undo some things to get in order to go forward again. Okay, avoid using the same bank. Okay, and last but not least, of course, not getting expert help. And I know that if I'd got expert help way back when I came home from East Timor the first time around, I wouldn't have bought locally, I wouldn't have bought a negatively geared property, I would have maintained a cash buffer, I would have structured correctly, and I would be, I'm doing okay now, but I would be a lot better off than I am. Okay, so you've got 2 choices in life. You can accept or reject your lot in life. You can write your own rags to riches story if you're willing to educate yourself and take the action that is required. Okay? If you want to be successful, you have to take the eagle approach. It's an old saying. If you want to soar with the eagles, you can't fly with the turkeys. But it's very, very true. Okay? There's a reason why 90% of the population is not wealthy. Okay, and of course in this webinar we've only scratched the surface as to what's involved in being a successful property investor. If you want to make me your personal strategist, if you want to get more help, then this is all you need to do, okay? If you do what you've always done, you're going to get what you've always got. So if what you've done so far, if you're happy with the results you've been getting, then stick to it. If you're not, then you need to do something differently, okay? And some of you may not know who Otto von Bismarck is, but they named the battleship after him, so he must have been a clever guy. But he was the head of the Germans in the early 1900s. But he had this, it's one of my favourite sayings, fools say they learn by experience, I prefer to profit by others' experience. And you know, by getting help, you're going to learn from the mistakes of others and not have to make those mistakes yourself. To book an appointment with us at Integrity Property Investor Services, $297 is what it costs. That includes GST. Take action, be accountable for your own situation, accept responsibility for it, and get on with fixing it. Okay? And we're happy to help you do that. And this is what we'll do. We'll have a strategy session with you first. In that session, we will confirm your goals and your current situation. We'll review your existing plan, what you've been doing to date, what your original intentions were, and then if necessary, we'll educate you in those bits that perhaps you don't understand as well as you should. Okay, we'll then talk to you about all the options you've got and to determine the most suitable for you. There's not a cookie-cut solution for everybody. Different people are in different circumstances. Some people are self-employed. Some people own businesses. Some people have government jobs. Some people have equity. Some people have cash. Some people have both. Some people are close to retirement. Other people have a long time until retirement. So it's very important that we sit down and work out what's most suitable course of action for you. We then create a new enhanced plan that you endorse, that you're comfortable with, and then we help you to find the right properties necessary to support that plan. We coordinate the team around you. If you need a new accountant, we'll get you a new accountant. If you need a mortgage broker, we'll get you a mortgage broker. Conveyancing solicitor, real estate agents who have got the right sort of properties in the right places. We get a whole team of people around you to make sure that it's successful. And then, of course, I and the team will stay with you throughout the process to ensure you're successful. Look, I've set this up in a way that it was everything I was looking for when I was starting out in investing. and I wasn't able to find it. It now exists. Okay, also, I don't make you sign anything. There's no obligation or contracts with me, and you can leave me at any time if you're not satisfied. Okay. Alright, and then here's what we'll do for you. I'll act as your personal strategist and advocate, someone who's 100% loyal to you and looking out for you, someone for you to bounce ideas off, someone for you to go to for guidance when you're not quite sure what your next move should be. I'll make sure your ownership structure is correct. I'll make sure you've got the correct finance structures as well, both myself and the assistance of the team of experts and the appropriately licensed and qualified experts in those areas, financial planners, mortgage brokers, accountants and so on. We'll make sure you're buying in the right locations, help you find the right properties in those locations, make sure you're not getting ripped off, and make sure you've got a team around you of all those people we've already indicated. Okay, if you enjoyed that webinar and you'd like to speak to us further, if you're watching this live, all you need to do is put appointment please in the question box. If you're watching your recording, just send us an email right now, info@integrityproperty.com.au, or pick up the phone and dial the number 1300 372 677 and make yourself an appointment. As I say, it's no obligation, no pressure. Have that first strategy session. If you don't like it, you can walk away. But if you do like it, then great. I really would love to help you and be there, be that person that I wish was there for me when I started, and help you to be a success and avoid making the mistakes that many property investors make. Thank you very much for your time, and I hope you got a lot out of this webinar. Cheers.